Welcome to RPM, the podcast that explores the world of private markets. I'm your host, Maribel Yoo. Over the past few years, direct lending has presented itself as an asset class that provides stability, attractive returns, and limited declines. As bond yields have risen, some investors have been questioning whether direct lending offers the same value proposition as it once did. But yields are only part of the equation. Joining me to dive into the credit and duration risks associated with direct lending, its liquidity, as well as its volatility and drawdowns in comparison to fixed income securities, is Fabian Körzendörfer. Fabian is based in Zurich and is a member of our private debt research team, focusing on direct lending strategies in the US and Europe. Thanks for joining me, Fabian, and welcome to RPM.
Thanks for having me on this episode, Maribel. I'm excited to talk about the attractiveness of direct lending in today's market environment.
Perfect. Now let's get started. So bond prices and interest rates are negatively correlated, with some bonds more sensitive to rate fluctuation, resulting in greater duration risk. Why does direct lending have a lower duration risk than many public debt asset classes?
That's a very good question. Thanks to its floating rate, direct lending enjoys a relatively low duration risk compared to investment grade and high yield bonds. Because direct lending uses rates that float, cash coupons, which normally reset every 1 to 3 months, have been increasing as interest rates have been increasing, while the prices of the underlying loans have remained stable. So even as bond yields have risen in recent months, direct lending's floating rate has allowed it to deliver superior yields while maintaining low volatility. Thus, floating rates offer several advantages relative to other asset classes, such as fixed income. When interest rates go down, direct lending is also protected thanks to LIBOR floors that limit how long the coupon rate can go down, thus preserving the high current income. Let me make an example. Between the peak of 2018 and the low of 2021, the US dollar LIBOR decreased by around 2.7%, while the primary yields in the middle market for direct lending decreased only by approximately 1.5%. This is due to the protection that LIBOR floors are offering. In contrast, in 2022, the US dollar LIBOR increased by almost 4.7%, and the middle market primary yields increased by almost the same percentage, showing how coupons are able to track base rates. Therefore, the past few years showed how direct lending can offer downside protection while offering attractive upside opportunities through monetary policy cycles, thanks to its low interest rate risk when compared to other fixed income securities.
Thank you, Fabian, for breaking down duration risk. As any lender knows, creditworthiness is another key risk to mitigate. How do direct lenders limit credit risk?
Even with relatively higher yields in direct lending when compared to investment grade or high yield bonds, the asset class credit risk, where loss rates are used as a proxy, remains moderate. While being higher than investment grade bonds, it is twice as low as high yield bonds, potentially implying better risk-adjusted returns. Direct lenders are able to achieve superior risk-adjusted returns thanks to multiple characteristics prevailing in direct lending. First, the capital structure itself. The direct lending space mainly consists of first lien loans at the top of the capital structure, which are repaid before other debt holders, limiting potential losses from defaults. In addition, we have to highlight the presence of financial maintenance covenants. Unlike high yield and investment grade bonds, direct lending loan contracts also usually include financial maintenance covenants, which are typically tested quarterly based on the financial performance of the borrower. They protect lenders by imposing certain limits such as maximum leverage, minimum EBITDA, or minimum fixed charge coverage levels, and allow them to act preemptively to avoid a payment default event, while lenders in the public space would usually have to wait for a borrower not being able to pay interest or amortization in order to act. Furthermore, sponsors have a significant impact on credit risk. The largest portion of borrowers in the direct lending space is backed by one or more private equity firms. In times of financial stress, the private equity sponsor may provide an equity injection to help the borrower to stay afloat, thus reducing credit risk. Historically, being sponsor-backed has helped direct lenders generate relatively stable returns for their investors. The moderate credit risk, combined with the relatively low duration risk that we have just discussed, enabled the asset class to offer attractive risk-adjusted returns when compared to high-yield and investment-grade bonds. as well as to have stable IRRs per vintage. Looking at annualized total return between 2005 and March 2023, direct lending delivered 9.33%, while high yield offered 6.09% and investment grade 3.97%.
Great. Now, because it's an alternative asset class, many regard direct lending as being illiquid. In the article we just published, we explored different features that could provide cash to satisfy investors' needs. How illiquid is direct lending?
Direct lending is considered an illiquid asset class as it is part of the private market space, but it possesses certain liquidity features which distinguishes it, for instance, from private equity, which exhibits longer investment periods coupled with unpredictable cash flows. The liquidity features of direct lending include several aspects. To start, direct lending offers a high and reliable current stream of income through its coupon rate, which provides a consistent and predictable stream of liquidity that remains stable throughout the business cycle. Furthermore, direct lending benefits from capital repayments. Direct lending loans typically have a legal maturity of 5 to 7 years, but the usual effective loan life is closer to 3 years. This means that loans are repaid rather quickly when compared with the legal maturity. As a result, once the portfolio enters the run-off phase, it can generate significant cash flows. For instance, in a base case scenario of a portfolio entering the harvesting period, investors could see almost 40% of the portfolio getting repaid in the first year and 80% by year 3. In addition, we should highlight the secondary market as well. Direct lending offers the possibility of secondary market transactions to investors who need faster access to cash. Such transactions may take more time to conclude compared with those in the public market and might require offering a discount to close the deal. However, due to stable valuations, secondary discounts may actually be lower than realizing a loss in the liquid markets. In addition, the secondary market is rapidly developing, enabling the execution of very large secondary sales. Lastly, there have been new fund structures offering liquidity. Recently, direct lending managers expanded their offerings by setting up evergreen funds with embedded liquidity features. Those funds are usually subscription-based with a low minimum ticket size, which provides investors with greater allocation flexibility as well as direct exposure to the asset class thanks to instant deployment. Moreover, such funds normally also allow for quarterly redemptions up to a predefined percentage of NAV, giving the possibility to withdraw some cash to meet liquidity needs when necessary.
That was very helpful of you to go through each of the liquidity features. Now, as these features help to differentiate direct lending from other asset classes, can you talk through some of the potential advantages?
Sure. The liquidity of the asset class also offers some advantages not present in the public market. Worth noting when making a portfolio allocation is particularly the illiquidity premium, which is a premium that compensates investors for the illiquidity of the asset class. It is estimated to be at around 2.1%, and this premium could be particularly attractive to long-term investors who are less concerned with liquidity risks. Furthermore, the limited volatility that we see in this asset class has to be considered. Among other factors, such as duration risk, the illiquidity of the asset class shields it from a major fluctuation in financial markets, lowering the volatility an investor's portfolio is going through. This was particularly evident in 2022, when investment grade and high yield bonds were quite volatile, while direct lending remained much more stable. Finally, while public markets are very liquid, part of this liquidity tends to evaporate in times of market stress, which is usually when investors would need it the most. Wider bid-ask spreads, coupled with discounted prices, may push investors to postpone selling public securities to avoid realizing material losses. Hence, it is an important factor to take into consideration when assessing the liquidity of fixed income securities.
The illiquidity feature of the asset class certainly presents some advantages. How volatile is direct lending compared to public debt?
Thanks to its illiquidity and low interest rate duration, direct lending experiences significantly less volatility than public markets, such as investment grade or high yield bonds. Its very low interest rate risk relative to public securities was particularly visible in 2022, where direct lending benefit from higher interest rates with fairly stable valuations for the underlying loans, while high-yield and investment-grade bonds experienced a sharp decline in prices, resulting in the worst losses since the global financial crisis. Demonstrating the resilience of the asset class, direct lending was the only among the three asset classes to deliver positive total returns in 2022, with 6.3%, while high yield delivered a negative return of 11.19%, and investment grade resulted in a return of minus 15.76%. In addition, high yields in public markets are usually the result of market dislocation and high volatility in the market, requiring investors to time entry and exit points to capture them. In contrast, direct lending offers stable returns over the business cycle, making it less reliant on timing than public securities. For instance, based on historical data, during the last 15 years, there were only 6 quarters in which high-yield bonds outperformed direct lending. Furthermore, investing in falling high-yield bond prices during these quarters would have also introduced volatility into the portfolio.
So with direct lending's relative illiquidity and its low interest rate duration, these factors contribute to the low volatility of the asset class. Can you discuss how direct lending drawdowns compare to public markets?
The low volatility combined with other factors such as relatively low duration and credit risk has enabled direct lending to continually perform well relative to fixed income securities in both benign and inclement conditions. Looking at the past 2 decades, direct lending experienced lower drawdowns than investment grade and high yield bonds in general. During the global financial crisis, but also COVID-19, direct lending drawdowns were comparable to investment grade and thus much lower than high-yield bond drawdowns. More remarkable, in 2022, investment grade and high-yield bonds suffered drawdowns in the double digits, while direct lending did not experience any drawdowns. This is again demonstrating the resilience of the asset class and a particularly attractive feature of direct lending, given the uncertain macroeconomic outlook we are heading into, as it provides a reliable and stable source of returns across the entire credit cycle.
Well, direct lending is not as illiquid as one might think. You've given our audience very helpful insights on the relative attractiveness of direct lending. Thanks again for joining me, Fabian.
Thank you, Maribel, for hosting me. It was a pleasure to show the high attractiveness of direct lending. Despite the recent moves in public markets, particularly due to the low term and credit risk, its liquidity features, but also lower volatility and drawdowns, we think direct lending remains a highly attractive asset class.
That does it for this episode of RPM. Thanks for listening. For more research and information on private debt at Stepstone, visit us at stepstonegroup.com. RPM is available on Apple Podcasts, Spotify, Stitcher, and other podcast platforms.